Okay, so welcome to this session where we are going to unpack the disruptions that have happened on trade, on the economy, and on financial markets in the last 100 days. We could have taken 100 years, but we've decided to take 100 days, especially following the announcement made by the US president to impose a set of tariffs on Mexico and Canada and then pause them. Put a number of tariffs on vehicles, on steel and aluminum, and keep them. Put tariffs on a set, basically on the world, so-called reciprocal tariffs, and then reduce them at 10% and start a process of global negotiations. All of this has had major impact on stock markets, on bond markets, especially on 10-year US Treasury bond markets, created confusion, uncertainty, damage, maybe irreparable damage. All of this is what we want to unpack today with a stellar cast of speakers, starting to my right with Pascal Lamy, coordinator of the Jacques Delors Institutes, but for the purposes of this conversation, former Director General of the World Trade Organization, and former EU Trade Commissioner, my former boss, incidentally. To his right, Thierry Meyer, our own Thierry Meyer, professor of economics here in Sciences Po, professor at SIA, thank you. To my left, Tobias Gerke. Tobias is a senior policy fellow at the European Council on Foreign Relations, focusing on geoeconomics, author of a very detailed paper on what assets the EU has to respond to the current circumstances. And connected online, two great speakers, Jason Furman, professor at Harvard Kennedy School, as well as at the Department of Economics, non-resident fellow at the Peterson Institute, and also former chairman of the Council of Economic Advisors of former US President Obama. And last but not least, Henry Gao, professor of law at the Singapore Management University, and someone that knows what's going on in that part of the world. So without further ado, let me just put a few questions to our panelists, and then, as is customary in this house, the floor would be to you for you to put your questions on the table. Let me start with Pascal. Is this, as some say, the end of globalization, and is this the end of the multilateral trading system that you help build?
Well, I'll tell you the big picture as I see it, including your question. First, I do not think we are witnessing the end of globalization. Second, I hope we will not see the end of multilateralism. And third, I fear we might see the end of democracy in the US. That's the range of dangers. And your question relates, understandably, given the theme of this conversation today, to the first part, the geoeconomic part, which, in my view, is the less dangerous of the three. I believe Mr. Trump is aiming to deglobalize the US, to make America stronger. He wants to deglobalize China to make China smaller. And he wants to deglobalize Europe to make Europe more divided. That's the view he has of where he wants to go. And he seems to sincerely believe that that's the way to go. He's deeply convinced that the future of the US is to step back from its international responsibilities. But I do not think it will work. The first reason why I do not think it will work is that the infrastructures of globalization will remain. Global market capitalism and the trade system that goes with it is based on infrastructures that allow and facilitate trade, physical infrastructures, internet, satellites, ports, ships, submarine cables that help transporting what will matter more and more in international exchange, which is data. Second reason why I think it will not work is that the vigilantes of globalization, as they call them in the US, are there. And the vigilantes of globalization are A, financial markets, starting with bond markets, and B, a bunch of 20, 30 leaders of multinational companies who have access to Mr. Trump's office in the White House and whose power on global market capitalism is probably stronger than the one of the President of the US. And third reason, and last one to remain short, why I believe it will not work is that it will be too costly for the US. Globalization is efficient and painful. Deglobalization is inefficient and painful. And that's what we are witnessing for the moment. And hopefully, seen from my point of view, more to come. So, at the end of the day, of course, I believe, the US will remain surrounded by a tariff fence of a sort of, let's say, 15% trade weighted, which is 5 times higher than before the 2nd of April, which will negatively impact the US economy and the world economy, although in a lesser proportion, let's say 1% for the US, 0.6% for China, and 0.23% for Europe, roughly. That's the order of magnitude of the damage. But this will not be the end of globalization. A 15% US tariff fence is a relative price that matters for localizing production and consumption, like the minimum wage in China, like the price of oil, like the price of carbon, hopefully. So this will not be a deglobalization. Of course, globalization will adjust. Trade flows will adjust to decisions which will be taken, or where do you want to produce, which part of what, given the new distribution of comparative advantages, but this is not the end of globalization. It's globalization morphing according to a significant change in relative prices, of course, and these relative prices being significant not because it stems from markets, but it stems from an executive order by a guy who believes with his voodoo economics that tariffs is the way to go. It is not the way to go, and at the end of the day, it will show.
Thank you. Pretty clear. Let me now move to Jason. Jason, let's have a look at the impact of tariffs on the US economy, and I want you to, in particular, address the impact of those measures on the US dollar. Because behind all this talk about tariffs, there is also the almighty dollar, as we put in the title of this session. Jason?
Great. Well, it's great to be with all of you, and just thumbs up if you can hear me.
Yes.
Okay, excellent. So first of all, I just want to say that for the last many months, there has been this constant attempt to find some explanation, some theory, some plan for everything the United States is doing. I think most people have increasingly understood that there is no method to the madness. In fact, there is just madness. But for the few people that had any doubts on that score, President Trump should have put them to rest yesterday when he came out with a proclamation that foreign films are a national security threat to the United States and that he was placing a 100% tariff on those foreign films. Now, I don't know how they're a national security threat. I don't know how you place a tariff on a foreign film. I don't know why you would pick this industry where the United States is a big net exporter. And I think there might even be people in France that think we are a national security threat through what we're doing to their culture. None of it makes sense. It really is just madness. The short run impact, there can be no debate about. It is going to be higher unemployment, higher inflation. The relative magnitude of those two is a question. I bet more on inflation than unemployment, but I'm not sure. The effect on the United States will be more severe than the effect on most other countries in the world because the United States is in a trade war with every country in the world, whereas most other countries are just in a trade war with the United States and still are able to trade in a relative. What I am worried about is what the long run trajectory here is. And this will get Arancha to the issue about what this means for the almighty dollar. Right now, we have average tariffs of about 20%. I think they're more likely to go down than to go up, but there's enormous uncertainty and anything could happen. But the plausible best case is that we end this administration with an average tariff rate of around 12%. That would be much higher than it's been since the 1940s, much, much higher than it was just prior to this. But here's the thing, once we're there, I think there'll be a certain stickiness to that tariff rate because whenever you change tariffs, it causes disruption. And if we've had 3.5 straight years of tariffs at that rate, businesses will have gotten used to it, even though it will be lowering the level of our GDP, lowering the growth rate probably by a tiny bit as well. The short run disruption of bringing those tariffs down could be quite hard. And so I agree with Pascal. It's a relative price. It's one among many in the global economy. With a 12% US tariff, that wouldn't be the end of globalization, but it would mean for us less exports and less imports, probably just about the same trade balance that we have now. So what does all of this mean for the dollar? That's the one thing that I'm actually somewhat cautiously optimistic about. The dollar depends on what the alternatives to the dollar are. They're still all flawed in a lot of different respects. The colleague of mine, Larry Summers, has talked about how it takes decades to build a forest, but only a few hours to burn it down. I mostly don't agree with that. The Treasury market is large, it's liquid. U.S. rules on U.S. capital flows are very transparent and predictable, and there will continue to be a lot of benefits from having dollar reserves, invoicing in dollars, and the like. That being said, it does affect the value of the dollar, and here it's a little bit confusing because the fundamental impact of larger tariffs plus the larger budget deficits I expect us to be running would tell you a stronger dollar. But if you add a bunch of uncertainty and confidence effects, you can actually end up with a weaker dollar. And that's what we have seen so far. I sort of bet on the economic fundamentals of the tariff strengthening the dollar over time, but what happens to it depends not just on trade policy, but things like respect for institutions, most importantly, the institution of the Federal Reserve. The very last thing I'd say is a big open question for the question of globalization writ large is what other countries do with respect to each other. And is there a imitation of the United States? If protectionism works well here, why not try it there? I think more likely protectionism is not going to work well for the United States. The world will see that. And if anything, it might be a cautionary tale about the dangers of rapid attempts to delink from China, deglobalize, and so might lead other countries to try to strengthen their trade relationships with each other and resist the extremely foolish course of policy that we're unfortunately undertaking in the United States.
Many thanks, Jason. Get ready, because in my second round, I'm going to ask you what you think should be the European game, not the American one. We'll change roles.
I think they should listen to you, Arantxa, but I'll try to answer when you get to me.
All right, let me go to Henry now. Henry, give us a sneak preview of the impact of the measures on China, and what is likely to be China's game plan.
Sure. Thank you, Arantxa. I'd like to talk about two issues. The first is how has China responded, and the second is how should China respond. So China has responded largely by retaliating against the U.S. Tariff threats. So starting from the initial 34% tariff, we have seen that China has retaliated round after round, resulting in now 125% tariff against the U.S. Plus the 20% fentanyl tariff and the 25% tariff from the first in 2018. So total tariff between the two countries is now up to 170%. So China has done this because China thought that it could basically react to the U.S. Tariff escalation without much damage to its own economy. And the reasons were actually provided in detail by some of China's official publications, like this editorial that was published in the People's Daily on April 7th, in which the editorial basically said that we have fought the trade war during the first term, therefore we learned the lessons, we are well prepared this time, we are not going to lose. But I would argue that if you look at it, the economic front, actually China is in a much worse shape than back in 2018. Because in 2018 to 2020, during the first trade war, China actually benefited from the COVID pandemic because of China's unique political system. It was much easier for China to basically mobilize the country and also to impose the strict lockdowns, which means that the economic impact on the country was minimal, which explained why, despite the trade war, China still recorded 8.4% GDP growth in 2021. But this time around, if you look at what happened since the end of the COVID zero policy in China, at the end of 2022, the Chinese economy is really in bad shape, and it hasn't fully recovered from COVID. So nowadays, unemployment rate is really high, and I don't think China is really well prepared for that. Of course, China is not only fighting with economic tools, it's also fighting with things such as legal tools. So you see China has beefed up its so-called legal toolbox for fighting against the US, including the national security law, the unreliable entity list, the blocking statute, the anti-sanctions law, and the foreign relations law. And China has been using these laws in recent cases to try to deter the foreign countries from complying with US sanctions and imposing restrictions against China. But this is actually a double-edged sword, because if you use this too aggressively, then you could scare the foreign firms and they might leave China. And the last tool China has been using is diplomatic tools. So the editorial that I mentioned earlier actually talk about China's reducing reliance on the US, where they said China's export to the American market has fallen from 19% in 2018 to 14.7% in 2024. On the other hand, China has been exporting more to the other regions. For example, its exports to the BRI countries for the same period had jumped from 38% to 47%. But I think these numbers only tell part of the story. For example, China's increasing exports to the BRI might have exceeded those to the US, EU, and Japan combined. But much of that are actually rerouted trade, because if you see China's export increase to countries like Vietnam and Mexico, at the same time, you see actually these countries, their export also increase by corresponding amount to the US. So actually a lot of these trade are actually transshipment. So this can also be seen by China's recent diplomatic moves. So right after the trade war was launched, Xi made state visits to Southeast Asia, to countries like Malaysia, Vietnam, and Cambodia, and tried to rally these countries in fighting against the US along with China. But unfortunately, nothing concrete has come out of his visits, and that is not surprising. That is because if you look at this country's trade structure with China vis-a-vis the US, they all have a large trade deficit with China versus the large trade surplus with the US. For example, Vietnam just exports 42% of what it imports from China, while Cambodia's trade deficit with China accounts for 30% of its GDP. So I think it is no surprise that these countries are probably going to choose US because they still have to rely on the US as the major export market. Now let's move on to the second question, which is how should China respond? I would argue that the answer is very simple. China needs to boost its domestic consumption. Now, the whole route between the US and China is because China simply produced too much. It produced 30% of world industrial output, but it only consumes less than 10% of global consumption. On the other hand, the US makes up about 30% of its of global consumption, while its population is much, much smaller than that of China. But this is easier said than done, because the issue of boosting consumption is not an economic issue, it's not an economic issue, it's more of a political issue. Now, the root cause for the low consumption is the low household income in China. But in China, low household income isn't the failure of the system, it's actually the feature of the system. The CCP actually relies on keeping wages down and household consumption low in order to maintain control. Because if you raise incomes and allow the people to keep more of the wealth they create, allow the people more choice in what they want to consume, that would empower the people. It would create a larger, more independent middle class. And that's what the CCP is afraid of. They don't want the people to have the choice, because having the choice would mean that the CCP has to relinquish part of the power. So that is the real risk for the party. So for the party, economic slowdown is not a problem. Foreign pressure is not a problem. But the political consequences of letting the people having more choice is the problem. So while the solution seems obvious, I don't think the CCP is likely to go down that path. So unfortunately, this means that at least in the short to medium term, we are not going to see the solution. Thank you.
Thank you. Thank you, Henry. Let me now move to Tobias. Impact of the measures on Europe, and what should be Europe's game plan? You've written extensively about this, so you've given it a thought.
I have. But first on the impact, what is the impact of the tariffs? I think you can answer this in two ways, economic and political. Both are important. On the economic front, I think the impact so far is limited for one of the reasons Jason mentioned. It's mostly a US-China trade war at the moment. Europe has options. There's also another factor is that a lot of, not all, but a lot of European exports are quite specialized. So a lot of companies are cautiously optimistic that, at least in the short run, a lot of their products, they will just push them through. And Americans will pay the price of the tariffs, at least for the time being. There's also the China factor. That means if China is completely blocked out of the US market or at a significant level, some of that trade the Europeans might pick up for machinery and so on, where the Europeans lost market share in China, in the US in the last couple of years. There's some cautious optimism to say, well, if China loses some of its market share in the US, we can pick up some of that. So the economic picture is not that terrible, at least in the short run. The political picture in Europe is also not terrible. I think there's great unity so far. The member states, by and large, stick behind the Commission. There's also, a lot of us expected that when the Trump tariffs would come, that they would differentiate between the member states, that they would say, in fact, these tariffs are only about Germany. So Italy, we can do a deal, and Hungary, we can do a deal. And that would fragment the member states. They didn't do it, but they could still do it. It's not a totally out of, could be a thing that they could follow up on, but they didn't, and we're sticking together. The Europeans also largely have some political fruits to pick on trade diversification. Many countries are coming to Brussels to want to deepen relationships or get over some of the sticking points of trade negotiations with Indonesia, Malaysia, Australia. So there's also some positives there. And even on the single market front, the reports that Letta and Draghi have written in the past that have been largely, unfortunately, not been picked up, they're now being discussed much more seriously, I think, in Brussels. So also quite positive. And on how to respond, do you retaliate against the Americans or do you not? There's also broad agreement that we should be cautious and that we should not roll over, that there should be some sort of pushback. So by and large, I think so far it's okay, both politically and economically. I think the Europeans hold the line. But that's also very short-termism, and things could change quite significantly, I think, when other countries start to pick up deals with the Americans. If the Japanese and the Koreans do get deals that would then disadvantage the Europeans, I'm worried that some of the nerves in Europe could start to flatter. A comment on the game plan. I think the Europeans, if I would think of very briefly what is Europe's game plan, I think it's, number one, it's trying to understand what the Americans really want, right? There's many different objectives of these tariffs, who wants what and who has a real mandate to actually negotiate. Turns out not really anyone except for Trump, but to understand what are the main goals of the Americans is one thing to do. The other one is observe the markets. Clearly markets are moving, so what kind of impact does it have? Let's look a little bit and see if the markets, if the dollar that Jason explained, if that has any impact on the Trump administration. The third one is look at negotiations. The Europeans are doing a lot of test balloons. There's a lot of meetings. There's a lot of test balloons of what we could do, maybe more soybeans, maybe more LNG, but nothing super concrete, I think. And the final one, the fourth item is limited retaliation, that most member states agree. There's one package already on retaliation, a 22 billion euro package of American goods that member states have more or less politically agreed we're going to retaliate if we don't find a deal in 60 days. So it's suspended as well. We haven't retaliated, but there is a loaded gun, basically. So that's, I think, the game plan as it is. I add two more points what I think should be in the game plan going forward. I think, first of all, we need to be better at outlining what we really want from this negotiation. There's a lot of trying to understand what the Americans want. Turns out they don't know themselves, really. We should write down what we want. For me, very clearly, not just getting rid of the reciprocal tariffs, but also we need serious concessions on these sectoral tariffs. They hit us very hard. Auto, pharmaceuticals coming, steel, this is just three categories. We export 260 billion worth of these three goods, these three categories to the US a year. That's big. And if we don't get any concessions on that, I don't think there's a reason to think of any deal. And we should be very clear about this and write this down. And the second element is, I think we need to increase our negotiation leverage by having a much bigger package of how we would retaliate. I just told you we have this 22 billion euro trade package. That's basically a loaded gun. My belief is right now is the time to say, and we're going to add more. And we have lots of reason to add more. We just responded on one part of the tariffs of the Americans, on steel and aluminum. We could respond on cars, on the reciprocal ones, on the US. So we should now create a package that we say, if in 60 days we don't have a deal, I mean, we're going to fire big time. Doesn't mean we have to. No one has to fire a gun that you loaded. But I think right now is the time to increase that leverage. And we have a lot of targets that we could do. You mentioned this report. We could target a lot of American service providers in Europe in quite specific ways. And I think now is the time to increase that leverage.
All right. Thank you, Tobias. Let me go to Thierry. At the end of the day, there is always somebody else on the other side, and this is businesses, right? And you've done a lot of work on the impact of these measures on businesses, and in particular on the automobile sector, which is subject to 25% tariffs, and something that's not negligible. So what does it look like from the business side?
Okay, thank you first for having me here. So I've worked in the auto for the analysis of what is going to be the consequence of this kind of measures for the auto industry. The auto industry is a good example because first, as was just said, it's big in those flows. It's a really big part of trade. The second thing is that it's really Trump's obsession, but it's not only Trump's obsession. It's like every single country that produces cars is obsessed with cars. And you can think about the Germans, but actually the French are no better. We're just obsessed with how many cars are we going to produce on our soil. So it's very politically charged. And the most interesting part for the economists is that this is a typical industry where you have two really complex things going on. First, it's a high capital intensive industry with super high fixed costs, which means that the location really matters. You don't put a plant in every single country. And the second thing is that it's really the paramount sector of global value chains. That is, a car is now consisting of systems of car seats, computers, now the battery for the electric vehicles, engine and transmission, and each and every single of those parts crosses borders multiple times. Particularly in the NAFTA, USMCA now, sometimes you get this one part that crosses 5 or 6 times the US-Mexico border and then goes to Canada and then crosses with the US some more, okay? And it's still not very clear after many, many executive orders, are you going to pay 25% on each of those crossings? How are you going to capitalize that? It's still completely unclear. So this is a very complex thing, and if, as Pascal was saying, the bottom line is 12 to 15% tariff, actually the car industry, as any type of this business, it's a little bit the same in pharmaceuticals or in computer chips. They can adjust. They know how to adjust their global value chains with that. So if they know what's coming, they can actually adjust. As was said, it's going to be painful, but it's going to be done. And the problem is that there's really no clear plan, as Jason said. And the more you go, the more obscure the plan is. For autos, it's been one announcement after the other, 25% on aluminum and steels, which is an import. Do you add it on? Then there's the fentanyl thing on top of 25% for Canada and Mexico. Does it add on or not? Nobody knows, actually. Even the latest 2 days ago executive order didn't really simplify that. So when you have to invest something like 2 billion euros to produce an assembly, a factory for assembly or for batteries, you better know what you're doing because it's going to be here for 25 years. So what's happening right now, instead of what Trump is expecting and telling you, is that everything is frozen. There's no more, there's so many cancellations of battery investments in North America. And so because those companies, they just don't know what's going to happen. So we've done a little bit of simulations at CEPI and here at Sciences Po about what would be the impact of the current state of affairs. The worst hits are going to be Korea. In terms of production of cars, are going to be Korea because it still exports a lot from Korea to the US. Canada and Mexico are going to be also very much hit, and it's much worse for them because their car industry is a bigger part of their economy, and it's really, really concentrated to serving the U.S. You're talking about minus 20%, 25% of production. So that's really a massive drop for production of those countries. Inside the EU, as was said, it's very diverse. So Germany is going to be -5 or -6%. Okay, so Trump is obsessed with the BMWs in the street of New York, but that's not so big in the sense that the BMWs are mostly made in Germany and sold somewhere else than the US. It's going to be hit, but only 5 or 6%. UK, same thing, 4%, because all the Jaguar and Land Rovers are done in UK, so they're going to be hit by 25%. So that's the typical thing's going to happen. France, not at all, because we don't sell any car in the United States of America. So we're going to actually benefit a little bit from better situation in Europe. But the important thing is that France is not going to be hit on the auto industry, but on other industries. And the important thing it was said, I think, is that European solidarity is really important here. And Donald Trump did, I think it was a mistake, or I don't know what took him, of having a single EU policy towards the EU. It should have done, France, I'm going to hit your cognac, and Germany, I'm going to hit that, and I'm going to deal with all of them. Maybe he was afraid that there would be too complex negotiations, but that offers an opportunity to really have a good position of strength in the negotiation. I think, and maybe we're going to talk some more about this. I think the first EU reaction was the good one, in the sense that they said, okay, you want lower tariffs on cars, which is 10% versus 2.5. Fine, we're going to do that. We're going to do 0 for 0. We're going to actually return back to TTIP, which was the project of Obama time, which was killed by Trump 1. And let's do that. Let's do 0 to 0. You give me something, I give you something. That's okay. Of course, Trump didn't want that at all, and Navarro didn't want that at all. He's the mastermind, if you can call it that, behind all this. And so now they're getting back to this 50 billion euros of additional soy and natural gas purchases, which don't make any sense in any circumstance, and we're gonna talk some more about it. I think the final thing on cars and many industries that will remain about this in the future, and maybe after Trump, is that it's going to be hard to trust the U.S. government in the future for anything. I mean, think about Canada and Mexico. They already renegotiated during Trump 1. Korea renegotiated with Trump 1. China, they negotiated agreements during Trump 1. All of those countries, it's a surprise for us Europeans, but all of those countries, they should never trust the U.S. again. And that's going to leave way more trace over the future, I think, than what the current mess. Thank you.
Thank you. Thank you very much for this unpacking of the impact as far as we can see today, because this, as you say, keeps changing by the minute. Pascal, is it worth to keep investing in a multilateral trading system? And if so, what should the countries that care about it do?
Well, I agree. My assumption is that, and this is not an assumption, it's a number, the US are 13%, 1/3, of global imports. And second, my assumption, as previously said, I think it was by Jason, is that there will be no contamination. Now, if these two things remain true, there is ample room for the non-US WTO members to keep abiding by their WTO commitments and to find the necessary energy, maybe, to move ahead without the US, which is what they've been doing with the dispute settlement, for instance. When the US blocked as far as their own disputes was concerned, which is what they wanted to do, which says a lot that this Trump trade stance is just a paroxystic version of what the US stance has been on international trade since 2008, when they blocked the final part of the Doha round. There is ample room for others to, A, keep a rules-based trading system, and second, try to move on areas which the US have or would have blocked, like, for instance, agriculture, which is the area where, at the end of the day, they blocked the end of the Doha round. So, yes, there is room for that, and yet, we do not see much of that happening for the moment. There has been an attempt by Switzerland to gather a sort of coalition with a petition saying, who signs the petition that we keep abiding to the WTO, and we want it to remain strong, and we renounce protectionism, and we swear, It didn't really float. And my own sense is that the DG of WTO could be, let's say, a bit more active for something like this to happen. So my answer is, I think there is a virtue in WTO members, starting with EU and China, who have to be in this. Whether India will join or not is an open question. As we all know, India joining any agreement on trade is 10 times more difficult than an average WTO member. And that's a political reality in that country. So that would be, my advice on how to react. That would be my way to try and move things forward.
Thank you. I'm going to ask a question to Jason, and then I'm going to open the floor to you. So start thinking about this. We'll pass you the mic so that you can put the questions. Jason, you said that that there is no substitute for the dollar now, and it's true. So if you are sitting in the shoes of Europeans wanting a greater international role for the euro, what would you advise them to do now?
Yeah, so first of all, I want to amend. I previously said they should listen to you, Arantxa, but I think they should also listen to the problem with retaliation, and Europe has every right to retaliate, and it makes sense that Europe will retaliate, but every single form of retaliation will hurt Europe and will hurt the United States, because there's no economic policy in Europe right now that's there just to help the United States at the expense of Europe that you can get rid of. Every single thing you're doing because it's in your interest too. That says that there's a huge benefit to there's a phrase, in every crisis, there's an opportunity. And the opportunity here, and I think it was Tobias who referenced it, was things like the Letta and Draghi reports. Eventually going further and having something like a European finance minister, some greater degree of fiscal integration, some form of common borrowing. All of these are the types of steps that I think I would recommend Europe take regardless of the trade war with the United States. If this becomes an excuse to do even more of that, both because you need to and because there's more common working together, and what comes out of it is a stronger economy and an even more global economy. I think that would be terrific. Frankly, the same thing would go for China. Henry referenced this. China has long needed to rebalance towards more domestic demand and consumption. And if they use this as an excuse to do this and reply to the United States by doing something that they themselves probably should have done for their own economy, great, and more power to them.
Okay, thank you. Questions to the floor. Who wants to break the ice?
Thank you. So I would like to refer to the point on opportunities in times of crisis. So we see, even though it would be good to have more multilateral cooperation on trade and reinforce the multilateral system. We see an increase in regional and bilateral cooperation on trade right now. And I would like to ask you, do you see this maybe also as an opportunity for some countries that have historically maybe not really benefited within the multilateral trade system? And do you think this is also something that can be advanced at the same time, or do you see it as a challenge for multilateralism? Thanks.
Thank you. Pascal, do you want to go?
Oh, I agree that
Do you want to take this?
if the US market closes somehow, and we don't know the proportion at the end of the day, this is a very strong incentive for countries to look elsewhere. And this will trigger a reconsideration of market opening options which countries have. A number of these options have always been there, but they were not considered because the price of concessions which you have to make to get reciprocal market access was too high. But this price changes. If you don't go to the US, and usually they make good money in the US, then the threshold of whether this is a possible good deal changes. So this will happen. And it will happen, first and foremost, with the European Union, who has a series of bilateral deals which are cooking. Some of them have been cooking for many, many years, including in the Middle Ages when I was a European Trade Commissioner. So there's a lot of that on the table. And finally, and that's, I understand, part of your question, I've never thought that there was an option or a contradiction between bilateral market opening and multilateral market opening. I know my good friend Jagdish Bhagwati has written volumes about that, a very interesting academic, theoretical, Thierry, considerations, but the reality shows, and Arantxa heard me saying this many, many times, I believe in the Chinese proverb who says that don't mind the color of the cat provided it catches mice. If a bilateral deal catches obstacles to trade, fine, let's go this way. It sometimes would be a precursor of what people then do multilaterally.
Do you want to add anything on this?
Yeah, very quickly. Just I can only give the European point of view, and I think there are opportunities, as I said, also with other trading partners. But I also would caution a lot of these partnerships that Europe now might ink. You know, many of them are themselves exporters in Asia. We are an exporting country. You cannot just replace the American consumer like that. Also not with China, like was mentioned by many. China is also bent on exporting. So even I think there are some limits of what we can do. I think it's for diplomatic and for political reasons, it's great to do as many deals as possible, but it's, I think, easy to replace, not easy to replace the Americans. So, like Jason was mentioning, I think the Europeans have this one big advantage that no one else has, and it's the single market. This is a great report by the IMF that came up with these numbers of saying that if we would tackle trade barriers within the single market, it would amount to like a 40% tariff on goods or like a 100% tariff on services. I mean, it's just great numbers that really demonstrate we have so much depth in the single market that if we would be doing just one or two steps forward, we could really offset some of the things that happen. And I think that's an advantage that no one else has. Japan doesn't. I mean, they kind of have to play off what comes out of Washington. And so I think that's really an advantage that we have to now push as Europe.
I want to do a bit of commercial. There is a great study by the chief economist of BNP, who has calculated a 1% loss in the US market to a European firm can be compensated with a 0.1% deepening of the single market. It's worth reading because it tells, with very stark figures, this is the story. Who else wants to put a question? Do you mind going there, because we are also recording it so that our audience can hear?
So you mentioned that Europe has that the United States has a vast surplus of export services to Europe and other countries as well, and mentioned that we could enact some countermeasures as to retaliate the current tariffs. What would those countermeasures on services be specifically?
Yeah.
Well, I think the most realistic one would be you put basically a levy. Let's not call it a tax because a tax is usually done in national context, but a levy on digital companies, American digital companies. If you want to sell your service to European consumers, Facebook, Twitter, what have you, you need to pay a % of your operating profit to the EU. Not as a tax, but as a retaliation to the tariffs. France does it already as part of a digital service tax, so they do it nationally. And you could just take the same concept and say, we're going to use this now at the European space temporarily, just as a retaliation, not a tax. We're not taxing at the EU level. And you use it as a leverage and say, this is what's coming, and that's how we're going to offset the tariffs. That's very possible. You could do the same in financial services. For example, high-frequency trading of American banks. It's a specific operation they do. You could say, in order to do high-frequency trading in the EU market, you need to pay an amount in order to do that, continue to do that. And that's part of a retaliation. But it has never been done, and hence there's a lot of hesitation because we don't actually know how this works. But it could be done.
Okay, anybody else? Please.
Okay, so first of all, thank you very much for your takes on the topic. I wanted to ask, since we touched the impacts on the EU, on China, and on the businesses, if we could also see what the impacts may be for developing countries, especially those who are strongly reliant on the dollar's power and hegemony. Thank you.
Okay. So, Thierry, and then I'll pass the floor to Jason.
So that's really one completely neglected aspect because of the, northern tropism. So one country that will be hit very hard is Vietnam. Cambodia will be also, and those are the countries that actually were during Trump 1. There was a lot because of the tariffs imposed on China. There was a lot of relocation of Chinese manufacturing to Vietnam and countries of the peninsula. And so that actually made them extremely dependent on exports to the US. It created a boom in those countries, but they're very depending on those exports, and those are the countries that will be hit. The problem is that there's no reason why this will not continue, in a sense that this new range of tariff is going to generate more of those sort of relocation of stuff out of China and out of Vietnam now. But every single country, in the head of Trump and Navarro, every single country that has a bilateral surplus towards the US is going to be hit. So it makes those relocation now very hard to predict. But yes, I think, and also, all the initiatives like Everything But Arms, that's the European one, but there's the same for the US, that actually targeted poor countries are going to also be put on hold, and that's a real big damage.
So, Jason, do you want to complete this? And then I would have a final question for Henry about China-EU. Jason.
Yeah. So first of all, just I agree with Thierry. Very differentiated effects depending on the existing trade relationship with the United States, but also depending on something to be determined, which is what U.S. tariffs are like. I worry that a country like Vietnam strikes a deal with the United States that is a good deal, but then 2 years from now is running an even larger trade surplus with the United States because stuff that used to go through China is now going through Vietnam. We think that's evidence that Vietnam was unfair as opposed to evidence that the laws of supply and demand operate. And we do another round of attacking Vietnam with trade measures. So it very much is differentiated and very much depends. But the second thing is there have been people who've tried to say, oh, this country will benefit from this diversion, from that diversion. The latest IMF World Economic Outlook downgraded basically every country in the world. So we're talking about different magnitudes of harm, not a whole lot of countries that are going to benefit from this.
Henry, I wanted to ask you a final question about Europe and China, quote unquote, cozying up to each other on trade. How do you see that? Where are the opportunities and where are the to be avoided pitfalls?
Well, that's a great question, Arantxa. I would say EU and China have opportunity to collaborate, but I would say these are largely matters in principle, as Pascal mentioned earlier. For example, they could collaborate by tabling proposals for WTO reform in the WTO and calling for countries to reaffirm international rule of law and oppose unilateral measures. But when it comes to the bilateral trade relationship, I mean, because that touch on concrete economic interests of both parties, I think that would be harder. Because, as mentioned earlier, I think it was Jason, if I remember correctly, who mentioned this, when the Chinese exports to the US are blocked, then China would have no choice but to increase the exports to the EU. And the EU, actually, if you look at the global consumption share, the EU's consumption share is only 13%, 1-3. It's not 30% like the US. So I don't think the EU is really prepared to welcome all these flood of imports from China yet. So that is where I think problem would arise. Actually, we already start to see that when the EU has been negotiating with China on the price undertaking on electric vehicles. So that is an example of that. I would expect, that the longer it takes for the US and China to resolve their differences, the more there will be this concern for the EU to do something against these flooding exports from China. But I am hopeful that the U.S. and China could start negotiations sometime in June. My personal estimate is that they should start negotiating sometime by June because of China's economic position. I don't think they can hold out by June. So hopefully by June, life would be better for everyone so that everyone could have a good summer. Thank you.
Thank you. We've come to the end of this session. Let me provisionally end with what I see can sum up the situation. For now, the winner seems to be globalization. That's what we've learned in this 100 days. What we can't do, because this is a tentative summary so far, is convene in the next after the next 100 days to take the temperature again and to do this with the same cast of characters. Maybe by then we will see a little bit clearer. Many thanks, Henry, Jason, Tobias, Thierry and Pascal, who's had to leave because he had a 4 o'clock appointment, and many thanks to you for joining us today. A big applause for our participants.
Thank you.